And I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. Our top story this morning, as the offensive of Israeli forces in Palestine on Hamas continues. We are keeping a track of how global markets are reacting. To my left is Suyash Maheshwari. Suyash, it appears that Indian markets specifically opened in the green, and also global markets, US markets, also closed in the green. They have seemed to have factored in any sort of global turmoil this geopolitical tension could result into.
Absolutely, Shweta. So we are seeing a bit of rebound playing out across the global markets, except Europe, US markets, the Asian markets. US markets closed in the positive territory with about 0.5% gain yesterday. Asian markets also were posting strong gains this morning. Now, as far as the US markets go, Shweta, it opened lower yesterday amid concerns about the war. But, there was commentary from some of the top ranking federal reserve officials which suggested that the Federal Reserve is looking at the high yields, 10-year high yields in the US, which are currently hovering around the 16-year high, and this potentially could steer the US Federal Reserve away from raising rates, which was a major pain point for the global markets in the last couple of weeks or so. The Asian markets also saw a good opening today. As you can see, Kospi opened about 0.5% higher. Nikkei is currently trading about 3% higher or so. Even we saw that Israel Stock Exchange, Tel Aviv, saw a rebound where TA35, their benchmark index, was up around 1% after dropping about 5% yesterday.
All right, so a positive start there for a lot of Asian markets as well as Indian markets. Let's quickly get in our guest Kush Bohra of kushbohra.com joining us on the show. Kush, thank you for joining us. Good to have you on the show. I want to understand from you, was this anticipated, markets rebounding in the second trading session for the week? What are you making of the jitters that we saw in the global equities market as of Monday on the back of the massive geopolitical tension in West Asia?
Hi, first up, good morning, guys. It's so good to be here. Well, it was absolutely anticipated. I mean, perhaps if you would have connected yesterday, most of my commentary, in our advisory services and across, the media channels that I appear, was the fact that, we may be looking at a near-term bottom at 19,500, 19,450 kind of levels. Now, there were a couple of reasons for that. The first and the foremost was that, 19,500 had a very strong put base, even on Friday, at closing. And what was heartening to see is that on Monday morning, that put base just sort of got strengthened. Even when the Nifty slipped below 19,500 for a brief while, we saw a lot of additions at the 19,500 put. So that sort of gave confidence that the market participants believe this to be a near term, but also a very strong kind of support zones. Also, from a purely technical standpoint, let me just keep the geopolitical news aside and all the kind of news flow aside. I think last week around also when I was here, I mentioned that we could be spending some time in this 19,300 to 19,600 kind of a band. Again, this is the same zone where we spent about a month from all of August and early September. So even if we keep the news aside and look at purely technical, as a guiding light, until the earnings seasons begin, which is tomorrow with TCS announcing its numbers, I think we were expecting this to be a range-bound market. It's just that the geopolitical news gave us that much impetus, and that on the negative side. So yesterday was a buying opportunity. I firmly believe that the near-term bottom for the market is in place, unless of course there is some major news coming in from the US again, or if by any chance this conflict were to expand to other geographies or for a longer duration. Other than that, we believe that Nifty could hold on to those 19,500, 450 kind of levels and rebound from there.
Now, Kush, as far as the war in the Middle East is concerned, do you think that the worst is over? The so-called known unknowns like potential involvement of Iran in the war has already been priced in?
Well, with the caveat that I am no expert on, geopolitical matters, if I look at it from purely a market perspective, look, most of the times when these wars or conflicts have come about, they've turned out to be buying opportunities, in the near term, and for sure in the medium term, they've turned out to be buying opportunities. Now, if you see, and from what I've read and seen, in across media houses, the word truce is being used quite a few times already. The fact that they're ready to come on the table and have a discussion is something that I've seen and read. So perhaps if that is the case, then this could just be like a one-day fall that we've seen in the market because of this news. Now, if that were to happen, then as I said, that would have perhaps given the market the much needed near-term bottom that we're looking at. So as I said, if this matter doesn't really escalate, a lot of it is already priced in, and then we are seeing that today play out not just in the Indian markets, in fact across global markets also we are seeing that play out. Otherwise, the reaction could have probably been worse, and we would have seen a second day of fall.
All right. I want to specifically talk about the US Fed commentary and the members of the US Fed, and their commentary seemed to be less hawkish in the past few days. It appears that the long-term yields on the Treasury bonds seem to be, lifting some pressure off the inflation. Do you see a rate hike in the near term? Run us through what your expectation is as far as a rate hike cycle in the US is concerned, and are the inflation worries still a major pain point?
I have no two doubts that they still are a major pain point. Well, then I would say that there is a possibility that we could perhaps be looking at the end of this rate hike cycle. We could be nearing the end of the rate hike cycle, but that's not my concern. My concern is that these are measures that typically take anywhere from 18 to 24 months to sort of bear fruit. Now, if we see, it was about the same time, about 18 months, when the Fed started raising rates. Now, if everyone's talking about that soft landing, and if it does come about, then fantastic. But given the kind of treasury yield spikes that we've seen, although they could be slightly more political than just economic, but if those were to continue, and the real impacts of the rate hikes were now starting, we're seeing them to come in now, then perhaps the soft landing narrative might actually be challenged. So more than the rate hikes, which, as I said, is every possibility that we are perhaps closer to the end rather than the beginning, but the impact of all the rate hikes that we've seen in the past 12 to 18 months will sort of kick in now, and that is a bigger concern that I have, as I said, more than the rate hikes themselves.
Right, and that also begs the question, what happens with crude prices? We've been covering crude, impact on crude, and what a potential war-like situation in West Asia could play up as far as crude prices is concerned. Let's get in Vijay Bhambwani, who's the author and CEO of BSPL India, joining us on the show at this point. Vijay, thank you so much for taking time out. I want to begin by asking, what are you making of the volatility in crude prices? $4 a barrel up, $4 a barrel down, closing at about 97 as of yesterday. Is the volatility likely to continue?
Good morning, and thank you for having me on your show. I overall remain of the opinion that there is no super cycle in crude prices. Yes, there are supply side constraints due to shortages created by output cuts. The current war in Israel will add to upward pressure on crude prices temporarily. Much will depend on what happens with respect to Israel versus Iran. If the fighting is restricted to Israel fighting Hamas and Hezbollah, then I think crude prices will gradually settle downwards. If at all Iran is to get into the picture, if Iran is to enter the theater of war, then possibly Iran will resort to what they have done in the past, threaten to mine, naval mines being put in the Strait of Hormuz. Now, this is a choke point, a relatively narrow water body through which 22% of global crude oil flows via sea, and 18% of global natural gas flows again via tankers. That's not to say that there will be no passage of crude at all, but A, they will require naval escorts. B, they will require higher insurance premium. C, the cost of operating in an endangered war zone invariably pushes up the risk premium. So crude oil prices may go up sharply, but temporarily, if Iran was to step into the war. Should that not happen, then I guess the crude prices will settle gradually lower. Do remember, crude markets, though radar sensitive, are also very.
Well, it looks like we've lost Vijay. My colleague Karthik is also with us in the studio. Karthik, it appears from what Vijay has been saying so far is that if Iran is involved, there could be a temporary upward movement in crude prices. I think Vijay is back with us. All right, we'll get Vijay back, but Karthik, if Iran were to be involved, there could be a temporary upward movement in the crude prices, major blockade by the way of supply chain, but that's about it. No long-term impact?
So, Shweta, as we see it, I think Iran, maybe not directly as a state, as a country, but there is this indirect support to Hamas already offered through Hezbollah by Iran. So, for all practical purposes, Iran is very much part of this conflict already. Now, there are multiple other factors also playing out in the world right now. There is a voluntary crude oil production cut happening in the Middle East and happening in Russia as well. You've seen the OPEC bloc cutting oil production. You've seen Russia cutting oil production. So this, in any case, has been adding pressure to crude over the last couple of weeks, as we've seen. Now, there was a little bit of consolidation that we saw last week, but with the war, it has suddenly escalated again. The war has escalated, and proportionately, even the crude prices have escalated. Now, the question that begs to be answered is that are we going to see a Russia-Ukraine war-like oil price again when it had touched almost the $120 per barrel level? Now, if you were to contrast that with what happened, let's say, at the start of COVID, if you look at the chart here on the screens, you will see that when March 2020, the world realized that COVID is a present and clear danger, oil prices had actually bottomed out. And at that time, there were supply chain shocks due to which there was excessive oil available, for countries to pick up, but countries were unable to pick it up because of the supply chain disruptions. So we had actually seen crude bottom out to about $20 per barrel, and thereafter it has been rising. That peak that you see on the chart actually happened right at the start of the Russia-Ukraine war in May last year. After that, we've seen, while there has been a sharp correction, it has been on an upward rise because of the voluntary cuts that we've seen in oil. Now, for all practical purposes, Iran is already a part of the war. Saudi Arabia, another major oil-producing bloc, will it actively be part of the war? Militarily, it won't, it cannot, it doesn't have an active military. But all oil flowing into Israel from one side from Iran, from another side from Saudi Arabia, Israel, the ports in Israel being a constant sort of conduit to transport this oil back to Europe. A lot of European oil demand in the wake of Russian sanctions have been flowing from the Middle East. In fact, the entire IMEC, which is that cooperation economic corridor between India, Middle East, Europe, and thereafter US, all of that as a response to China's Belt and Road Initiative is actually being built on account of the fact that you need lesser trade barriers when it comes to oil flowing between Israel, sourcing this oil from the Middle East, flowing from Israel in oil containers all the way to Europe, and then from Europe beyond all the way to the US. So overall, I think Saudi Arabia is going to be more critical to watch for right now, and its relationship with Israel, and therefore is trade going to continue or get impeded is something we'll have to see. Iran, for all practical purposes, is participating in this war, if not directly, then definitely indirectly through Hezbollah. And we are seeing that there is this this shock right now on oil prices. And as Vijay was just mentioning, those prices could, with active participation of the rest of Middle East, only go up. Now, my question to Vijay is, I believe Vijay is back with us. Hi Vijay, Karthik here, good morning. I want to understand from you, are we likely to see the same levels on crude oil as we had seen at the start of the Russia-Ukraine outbreak?
Well, with OPEC led by Saudi Arabia issuing a statement that they are ready to open the taps should there be supply shortages. I think if at all we reach there, it will be more like a photo opportunity, a temporary blip up rather than a sustained $120 plus level on WTI. I don't expect it to go there in the first place, but if it does, I would be happy to short there with a very patient outlook.
All right. And with respect to participation of the rest of the Middle East in the war, we already know that Iran via Hezbollah is supporting the cause of the Hamas terrorists. So we know that Iran is in some way already a participant in the war, if not actively militarily, then at least with financial aid to Hezbollah. Iran, which again is backed by Russia, backed by China, already playing its own game in the war. So with that in context, how do you see Saudi Arabia and oil flow from Saudi Arabia flowing into Israel and from Israel to the rest of the world taking a beating on prices?
You see, if we were to take this current situation in 2023 with a linear comparison to 1973, the Yom Kippur War, a lot has changed. Now, you have Israelis warming up to diplomatic relationships with the UAE, Israelis talking to Saudi Arabia for re-establishing diplomatic relations. Benjamin Netanyahu in October 2018 flew into Oman and had a cup of tea with Sultan Qaboos in an unplanned visit. So the Arab world is now a lot more open to the idea of peace, and the Arab Spring had a lot to do with it. So I don't think you'll have a broader participation of the Arab world in this war, as you saw in 1973, unless a very new development like nuclear weapons or some mass-scale chemical weapons are used. So I think this will be a fairly narrower conflict as compared to 1973.
Okay, and specifically, with speculation or with anticipation, perhaps negative anticipation, if I can add, of ports in Israel being attacked and being bombed, that becomes obviously a trade restriction, a trade barrier. So, will that likely have a far more devastating impact on oil prices?
In the short term, yes. I think in the absolute near term, for a couple of weeks, you could see oil prices spike. But then let's not forget, markets always plan ahead. The very fact that you're seeing very alarming videos of mass-scale rocket fires and bombings, etc., the markets have already priced in that probability. So if at all there had to be large-scale panic, it would have started seeping into prices, which it hasn't.
Okay, so before we let you go, Vijay, one more question from me, specifically on inflation concerns. I think we all understand that oil prices are directly linked to inflation numbers. So soaring oil prices, if it reaches the $100 barrier, it is already a problem for India. But even for global economy, and therefore global economy, oil shock, higher inflation becomes a double whammy for India in any case. So how do you see the inflation story panning out if the war were to continue for an extended period of time and is not a short-lived outbreak, because we've already entered day 4 of the war, so it doesn't look like it's going to de-escalate anytime soon. So if the war continues at this pace, then how do you see global inflation panning out with respect to oil prices?
I belong to the school of thought which believes that inflation will be sticky. It's not transitory at all. I've been saying that since late 2021. Let's not forget the way the Russia-Ukraine war is resulting in supply chain disruptions in food. So you have oil, you have food. The worst kind of inflation is food inflation. You can't negotiate with demand for food. It's an essential item.
Absolutely.
So 2023 and 2024 will see higher inflation worldwide, not just India, worldwide. We'll have to learn to live with it. Unfortunate, but true.
Okay, and should voluntary cuts by OPEC and Russia now be eliminated? Is there room right now for any voluntary cut in production, given that oil prices are likely to rise in any case, and the price stability that they were hoping to achieve with oil cuts will in any case naturally stabilize?
And just to add to that, how significant a player is Iran in oil production? We know it's been ramping up its oil production, but if Iran is involved and the possibilities of which are panning out in that terrain, what sort of impact are we looking at as far as crude supply is concerned?
See, as a veteran oil trader, I take all these output cuts or output hikes with a gunny sack full of salt. The Fragile Five, which Iran is a part of, is a chronic violator of OPEC quotas. They exceed their quotas flagrantly. And even when output cuts are enforced, there are under the radar supply chains that keep working all the time. So oil markets are an enigma. They are about geopolitics. They are about terrorism. They are about supply and demand economics. They are also about what is known as marginal factors, which don't appear on the books. So I think these output cuts may be all good in theory, but there are then discount rates to the rack rates. Then there are alternate supply chains which don't really report the amount of oil exported. That will continue, which is why I said, give me $120 a peak that Karthik mentioned about. I'll be very happy to short with a very patient outlook.
All right, Vijay, thank you so much for taking time out from your busy schedule this morning. Appreciate you having us on the show. But Kush continues to be with us. And Kush, let's take that question with you and let's come back to India. What sort of impact are we looking at if crude breaches the $100 barrel a mark? We know that the likelihood of which is not unlikely given the volatility in the past couple of weeks. What happens thereafter?
The way I see it is the fact that this will certainly hurt our import bills, but it may not really have a very significant impact on inflation. And the reason for that is that this is I think we can safely call this the election year. We're perhaps about 12 months away from election from here in any case. So the impact on the ground may not be as direct or as big, even if we breach the $100 mark. So from my perspective, even if we get there, I won't be too worried from the inflation perspective.
Okay.
Although yes, some of the stocks will start feeling the pain for sure.
All right, and definitely a cut in the excise duty that government is hoping to collect on oil, because it will have to incentivize oil if it wants oil to be continued to sell in the territory that it's selling at the moment if the oil breaches $100 a barrel mark.
Yes, Shweta, and what we are seeing is that the upstream oil companies have also been benefiting quite a lot. ONGC, the stock is at an 8-year high. ONGC is at 8-year high. Oil India is currently, I think year to date it has returned about 50% or so. So Kush, what's your outlook on these upstream oil companies which have been benefiting from a surge in crude prices?
Well, I've not been a big fan of the, oil sector, anyway. There is a news-based movement that sort of comes out, there's a trend that sort of emerges and then sort of dies down. So as far as, the likes of ONGC, Oil India, these stocks go, currently, yes, they've been benefiting, and we've seen the kind of, uptrend that's already, underway in these stocks. So I wouldn't, hesitate participating in them as long as the trend is intact. But once, that sort of dies down, these are not, my regular or, top favorite, picks. So if I were to give a very specific view on ONGC, then 180 to 175 is the kind of near-term support zones that we're looking at. As long as that is held, I wouldn't mind taking a long position here and ride it all the way to 190 and 198 kind of levels. So yeah, I mean, as far as the trends no harm in riding that.
What about the downstream companies which have been reeling under the pressure, and especially since they have not been able to pass on that surge in crude to the end consumers?
They are my second least favorite, if that's even a thing. After the companies.
Oil is not well with Kush Bohra.
Not been wealth creators for anyone, right? I mean, in the long term. So as you can see, right, some of these have actually broken down below the support level. If I look at, something like a BPCL, 340, was a very strong support zone from the medium term perspective. It sort of breached that as well. So not a big fan. These are perhaps some of the stocks that we use as hedging, opportunities, in our portfolios and in our advisory services. So, once, the crude is, the oil is on the boil, these actually turn out to be a good hedging opportunity, by short selling them. So yeah, not a, very big fan of the entire play. But yeah, if you want to look at a hedge, against your long positions, HPCL, BPCL are some that you would want to consider.
And what's your outlook on Adani Ports? The stock saw a correction of about 5%. It's probably its worst fall in the last 6 months or so. I mean, the Haifa port only contributes to about 3% of its total cargo volumes. So do you see that the correction that we saw, the 5% correction that we saw, is kind of overreaction?
This is the perfect definition of irrational exuberance, right? Markets sort of just anything connected, remotely connected to the region was hammered. Now, Adani Ports was actually on our buying list for a while. Even despite the dip, the stock hadn't really violated the 20-day moving average up until this news came out. And just at the beginning of the show, we were discussing the fact that it looks like the worst perhaps is over, at least in the near term. For the markets, especially if the geopolitical news sort of subsides or at least improves. This is the perfect example of what we meant. Yesterday, the stock was down to about 790 odd levels. We're already seeing a bit of a recovery, underway here. So for me, if you have a view of, let's say, 3 to 6 months from here, Adani Ports might just turn out to be a good buy. This might turn out to be a good buying opportunity.
All right, and since we are on Adani, Adani is in fact in news by the way of a press release or a press note that Adani Group of companies came out with, anticipating that there could be negative reporting in the media, specifically naming Financial Times.
So I think, Shweta, that is a preemptive statement that Adani Group has come out with. To my understanding, Financial Times journalists might have reached out to Adani Group requesting a statement, and Adani Group in its preemptive statement has already published, stating that again it seems to be agenda driven malicious intention of the Financial Times publication and its reporters to again try and put Adani Group in the dock. And what Adani Group is saying is that it's pretty much a rehash of a DRI circular of 2016, which has been raked up again. And this issue of perhaps, pertains to another 40 companies, another 39 companies, plus Adani making it a total of 40, which were issued that DRI circular. And Adani Group statement preempting that report publishing by Financial Times, also calling it, intended towards financially destabilizing the conglomerate, saying there's nothing new in the report which is yet to be published, and looks like it's trying to cushion its impact on the stock market, trying to cushion the impact that Adani stocks could face, because we've seen in the past Hindenburg report, which was released in the month of Jan, saw Adani Group chairman Gautam Adani's overall wealth erosion come down to about a third. From 120 odd billion dollars to about $40 billion, which went up to about 60 billion. And thereafter, OCCRP, also according to Adani Group, rehashing the Hindenburg research report and presenting it in the month of August. And now another Financial Times report, which had originally published even the OCCRP report, now coming up perhaps with another report on the lines of either the DRI circular of 2016, which also has names like JSW Steel, Reliance Infra, and multiple other Indian companies, but saying that specifically cherry picking on Adani Group and doing another damning report is pretty much a target on Adani Group of companies, and there is nothing new, nothing fresh in that report. It's a rehash of what has been there in public domain in the past.
All right,
but
and how's the Adani stocks reacting to that news?
So of the 3 lakh crore that the entire market lost yesterday, 10% came from Adani Group of stocks. We saw a correction of about 2 to 5% yesterday. Well, most of it came from Adani Power and Adani Ports. We saw a 5% or so correction in Adani Ports. Similar sort of a correction in Adani Power as well. Although the stocks have since recovered, most of the stocks, for example, Wilmar is currently trading about 3% higher. Adani Ports is also trading about 3% higher. Total Gas is trading about 0.8% higher, and Adani Enterprises is also trading about 2% higher. So after yesterday's crash, I think it has eased some concerns as far as there being another report about Adani Group out in public domain.
All right, another report, and in anticipation of that report, a preemptive statement coming from Adani Group of companies. Kush, it appears that obviously there are efforts being made to perhaps, report on Adani, but what's important to point out is in the entire saga around reports of short selling, reports of whether there was stock market manipulation, the important crucial SEBI report that everybody's been eyeing on is not yet out.
Correct, and that's why I've also maintained a view that there are plenty of other fish in the sea. Why does why does a trader really have to pick the Adani stocks, especially given the kind of news flow around them? While I understand that, a lot of interest and a lot of participation does happen in these stocks, it's not a bad idea, unless, you are a high risk trader, you have all your risk management systems in place. It's not a bad idea to perhaps give them a miss. Now, these news flow, might continue for a while. And if that's the case, why would you want to participate in them? So my view is that, pick a sector, and look for other stocks in that sector, and you might want to ride that wave, which are relatively less volatile, or which have less news flow coming in. So that's how I would play. If I want to play in any other, in any space, that these companies have a presence in, if I have to play purely from trading perspective. So that's how I would actually play. Hence, you find very few recommendations on, the Adani Group. The couple that we really like are Adani Ports and Adani Power. But as I said, we've got a lot of options in that space as well. So why not just play that?
All right, Kush, thank you very much for taking time out this morning. Thank you for joining us with your views. And moving on to, a commodity that we continue to track apart from crude, and that is gold prices. There are various reports out there suggesting that there will be increased interest towards safe havens like gold, and which has been the case earlier to this as well during the Russia-Ukraine war, which is when you saw more and more people going towards gold, buying that crucial commodity where people expect there'll be less volatility.
Absolutely, Shweta, and I think the real spike that we saw in gold was again in 2020 COVID. So anytime there is a shock to the stock markets, stock and gold move in opposite directions. When there is this irrational exuberance, euphoria in the stock markets, people want to invest in stock markets and try and maximize their returns. That is when you see gold actually staying flat, or sometimes even going down slightly, though it doesn't. Over time, gold has not gone down, it only continues to rise. And then we've seen anytime there is any economic uncertainty, any black swan event. So, the financial crisis of 2008 being one, COVID being another one in 2020, we saw the Russia-Ukraine war in 2022, and now again we are seeing Israel going to war against Hamas, striking Israel, Israel retaliating. Anytime there is any sort of a shock in the stock markets, gold becomes a safe haven. Now, there were reports still, a couple of weeks back, which was suggesting that gold may not continue to be a safe haven anymore. This was at a time when there was no inkling of the Hamas-Israel outbreak. But one assumed that perhaps, the US dollar would be a better hedge if you really wanted to get out of stock markets, because stock markets come with volatility. But US dollar, given despite the inflation, despite despite other concerns in the US right now, slowdown in consumption, the dollar index has continued to rise. So there were reports suggesting earlier that US dollar might be a better hedge against gold. But what we are seeing last few days is that the interest in gold is renewed again. We've seen the war break out between Israel and the Hamas terrorist organization. 4 days of bombing, we are in day 4 today, and we haven't really seen any signs of the war de-escalating. Now, for once, it seems that while markets have also corrected, Indian markets have corrected, and globally also the shock that one would have expected from the war to deliver has not really been delivered. Despite that, there seems to be a renewed interest in gold once again. So it seems like the safe haven definition of gold is not yet outdated, and it continues to be a safe haven for investors.
And if you safe haven, let's quickly also get in Kunal Shah, because he's with us. We'll look at the price charts thereafter. Head of Commodities Research, Nirmal Bang. Kunal joining us on the show. Thank you so much, Kunal, for taking time out. I mean, we'll look at the price chart, but interestingly, gold prices, after hitting a 7-month low, once again inching up. Start of Monday, what are the prices in anticipation in this during the entirety of this week? What sort of upward movement are you expecting?
Well, in line with what you guys were discussing, gold is right now in a structural bull run as per us, and it is more of a strategic investment rather than just a normal investment, because we are already in a scenario where a sort of Cold War sort of scenario is emerging globally. If you see what is being happening on the geopolitical front, if you see what is being happening on the monetary front also, so the monetary base of the global central banks have expanded and the global debt have ballooned like anything. So anything goes wrong, what is your hedge? Like we saw it in this recent geopolitical turmoil. Gold prices shot up by almost $70 in a matter of two to 3 days. So we continue to remain bullish even for the week and even from the longer term perspective. And we are of the view that in near term, $1,900, and on a longer term, gold is heading much higher. We are of the view that $1,750, $1,800, these are the rates we are not going to see for quite a long time. So the gold is about to shift and move towards a new orbit going forward.
Okay, and this new orbit will also then raise concerns on the stock markets. Would it, Kunal? Because so far we've seen that stock markets and gold are inversely proportional to each other. But if you're saying that there is going to be a renewed, price hike and renewed interest in gold, will it mean that stock markets, on the contrary, will then continue to trade flat? If anything, perhaps even go down. Despite the war, we haven't yet seen stock markets, react the way one would have expected them to react. But you're saying that the renewed interest in gold would continue, but would it happen at the cost of investing in stock markets?
Well, I'm not a stock market expert, but what I'm able to make of is that this environment geopolitically and even from the what's happening in the global bond market, what's happening on the global monetary front, everything is pointing towards a one scenario that the growth going forward is going to take a hit, and that's not a very good news. But the markets can still, like you use the word irrational exuberance, market can still surprise you on the upside because the kind of money which has been printed in last 4 years, 3 years, the lag effect of that will continue to drive various assets. And that is one of the major reasons why, in spite of massive monetary tightening, in spite of massive hikes, interest rate hikes globally, the global stock markets have done fairly well. But what about going forward? How it is at some point, it is going to break some or the other things, and that time gold is going to go up exponentially. So I am not predicting any major fallout in stock market, but all I want to say is that going forward, the upside from the global growth point of view seems to be limited with whatever headwinds going on globally. And we believe that investment like gold, recently we have seen a good correction, good fall because of the rising yields, but the intrinsic value of gold is going to rise exponentially. And at this time, for everyone who is associated with the financial market, gold stands out to be a strategic investment.
But let's look at two scenarios here, Kunal. One scenario being that the war is indeed going to be a short-lived one. There is going to be intervention, there is going to be de-escalation. And if that happens, let's say about a week or so from now, by which time gold may have touched its, its at least monthly peak or, this quarter's peak. Thereafter, if there is de-escalation in global tensions in the Middle East, then we would see a fallout in terms of the loss to investor wealth because gold prices would come down. Scenario 2 being that if the war continues to be a prolonged war, which we've seen in the case of Russia and Ukraine, we've seen over the last 1 year, gold prices have been pretty much flat. We've seen a little bit of up and down, but we haven't seen the kind of surge or the kind of decline that one saw, let's say, during COVID or any other black swan event like the 2008 financial crisis. So in these two scenarios, the war being short-lived, as scenario 1, scenario 2, the war being an extended long period war, is how does the investment into gold as a hedge work across these two scenarios?
It's a very good question. So the first scenario, let us say that in a week's time or a 15 days time, the war is basically moderated and you come to some solution. And so in that scenario, $30 to $40 or maybe perhaps $50 of premium, which is built in gold prices, that will erode and there will be a downside in gold. So that is one scenario. Second scenario is the war continues, then obviously gold prices are going to go up. So there's no doubt about it. And the third scenario, which is emerging, that let us say there is a peace talk or there is some positive resolution, then we come to a scenario of what is going to happen with the rates, what is going to happen with the inflation, what is going to happen with the global monetary policy. So if the rates, right now gold prices are not able to go up is because of the interest rate. So if I'm a US citizen, I'm getting 5.5% interest rate in my savings account. Why should I invest in gold? Gold is going to give me returns of 9 to 10% on an average. So the appeal for gold is being eroded. But interestingly, in history, whenever we've seen such kind of massive interest rate hike, it is generally followed by a crash in gold prices. So this has been an exceptional year. In spite of 5.5% rate hike by the US, gold prices are still at $1,850 from the peak of $2,000. So gold ideally should have been at $1,600, $1,500 in this kind of rate hike cycle.
Right.
But the monetary base of all the global, especially the G3 central banks, have expanded to the skies, and they are not going to go back to the previous pre-COVID balance sheet levels. And that remains the base case scenario for us to remain gold. So any asset you try to find a valuation, whether that asset is undervalued or overvalued. And looking at the way the balance sheets of the Western central banks have expanded, gold is highly undervalued. So we are of the very firm view that 1780, 1770 should be the bottom for gold.
Okay.
And next year, it is going to test $2,300 to $2,400.
Okay, and gold versus US dollar, what would you advise investors at this stage? Doesn't the US dollar seem like a better hedge against the volatility than gold at this moment? Given that we don't know which of the three scenarios in the war are going to pan out.
Yeah, so the beauty of the market is that, there was a time 1 month back, everyone was talking about de-dollarization, dollar index was at 99, and suddenly dollar index is back to 107. So this is the beauty of these electronic markets. The general consensus is always defied, and that is what we've seen. The long-term view of the dollar, with so much debt around, US cannot increase rates significantly, or US cannot keep these rates higher for longer. That is our narrative, and we believe that somewhere in the first half of the year, next year, there will be indication of rate cuts. They cannot, because
but for that, you're looking at scenario one, that the war is short-lived. If the war is long-lived, and if we see the kind of impact on crude, that is going to weigh in on inflation in the US, and hence the higher for longer could become even higher for even longer.
I don't think so. The interesting part is that the theory, that the traditional theory, what we had, that the rising hike in interest rate will bring down the inflation. No, this inflation is not going to go, because all the money which have been printed, that money is not going to go away. So we are going to live with the inflation, because any time you see a scenario, they can bring down the inflation by hiking the rates, but at some point, if they stop it, again, there will be upsurge in the prices of commodities and dollar index will weaken. So I think this inflation is not going to go away for the long period of time, and we are not going to see, until we have a scenario that the major withdrawal of liquidity take place and market absorbs it. It's not going to happen. So the traditional theories are not working anymore. Okay. It's a market full of irrational exuberances, and hence gold should do well.
Okay, but what about open market operations? Sorry, Shweta, just one last question from my side.
Karthik is hijacking this bulletin.
RBI has said that it might, undertake open market operations. Do we see that happening in the US also to contain inflation and liquidity?
US is right now in a big fix. They cannot afford to, increase if the surge in bond yield is going to create problems for the government to service their debt. So that is one side. And if they don't do it, then again the liquidity will drive inflation. So they are in a big fix right now. So what they are doing is they are just saying higher for longer, higher for longer, higher for longer. It's not going to be. Whatever they've said, it has never happened in last 3-4 years. They said inflation is transitory, inflation is permanent. So my narrative is that the rate hikes are not going to continue going forward. And we are going to see a complete U-turn, dramatic U-turn in the first half of 2024. And hence, I'm not expecting, I think bond yields will peak out at some point, and gradually you will see dollar index also declining and bond yield also declining.
Okay, so what happens to people who are waiting to buy gold at this point? So hoping to buy at dips, is that likely? Will the gold prices go downward anytime soon? Because festive season is around the corner. A lot of people are waiting now to buy gold.
My message is don't wait. Because we don't know what is going to happen. So maximum downside is what I'm saying is a $50-60 downside base case on the downside scenario. But the potential upside is going to be huge and humongous. And there's going to be all the central banks. Just give you one data. The last 10-year average of central bank buying gold was 400 tons. Last year central banks bought almost 1180 tons. This year it will be somewhere between 800 to 900 tons of gold. Recently, with the falling gold prices, central banks were buying gold. So I'm very bullish on gold. Central banks are buying. Why we are not buying? So don't wait for the correction and buy.
Okay.
And if one is to buy gold, what route should they take? Physical gold, paper gold, or
SGBs?
I think gold ETFs, sovereign gold bond scheme. Sovereign gold bond scheme is the most preferred one if you are a long-term investor for 4 years, 5 years horizon. It's the best tool we have in our country. Second would be the gold ETF, and the third would be you buying a physical gold.
All right, Kunal, absolute pleasure listening to you. I think the bigger message there is if you're waiting to buy gold, buy it now.
Wait no more.
Wait no more. Go ahead. All right, Kunal, thank you for taking time and joining us this morning. But moving on, the Nobel Prize in Economics this year has been awarded to Claudia Goldin. Goldin is a professor at the Harvard University, where she currently teaches labor market history. She's been awarded for her groundbreaking research on women employment and pay. Her work has advanced the understanding of gender gap in the labor market. Now, Goldin has studied 200 years of women's participation in the workforce. Her research reveals how women's salaries have yet to catch up with that of men, despite women gaining higher levels of education. Goldin is just the third woman to win out of 93 economics laureates as far as Nobel is concerned. So, third woman there winning the Nobel Prize in Economics. And with that, it's a wrap on this bulletin. Thank you for watching.
Literally every